After 50, the most expensive mistake isn't picking the wrong house, it's starting with the wrong question. Most people ask, can I cover the mortgage? Wealthy buyers ask 5 very different questions first. And here's what's surprising. Most high achievers I've met completely fail test number 3. They end up what I call house wealthy, but freedom broke. Let's make sure you avoid that trap. For decades, I've watched people over 50 make housing choices that appear logical on paper, but quietly strangle their financial flexibility. The truth is, buying a house later in life isn't only about having a roof over your head. It's about protecting your ability to handle emergencies, medical bills, travel, or even family responsibilities without your house turning into a financial cage. Here's the counterintuitive truth. Your home is a lifestyle purchase. Real estate, on the other hand, can be an investment. The wealthy note these are not the same thing, and that's why they apply these 5 tests before they ever get excited about ocean views or fancy countertops. Stick with me for the next 15 minutes and you'll walk away with 5 practical assessments you can run tonight, complete with real examples of people who succeeded and failed. I've also linked a 1-page checklist in the description so you can analyze any property step by step. Test 1. The Liquidity Runway. Before you ask whether to rent or buy, you first need to secure what I call your spending freedom. I learned this lesson from a financial advisor in Chicago who watched retirees trapped inside fully paid-off homes. With no cash on hand, those houses became nothing but expensive prisons. This test isn't about mortgages, it's about flexibility. It's the cash cushion that lets you say yes to helping adult kids, paying medical bills, grabbing investment opportunities, or even taking a stress-free vacation, even if the market drops by 25% tomorrow. The guideline is straightforward. After closing, you should still have 3 to 5 years of essential, non-housing expenses liquid and accessible. Not tied up in home equity, not buried in annuities with penalties, truly liquid. That means checking accounts, savings, treasury bills, money markets, or short CDs you can cash out without hassle. Let's run numbers. Suppose your annual non-housing expenses are $60,000. If you want a 4-year cushion, that's $240,000 you'll need liquid. Say you currently have $1 million in investable assets and are eyeing a home that will take $309,000 to close. That leaves you $691,000 liquid after purchase. So far, so good. But here's the stress test. Imagine markets fall 25%. Your $691,000 becomes $518,000. At a safe 3.5% withdrawal rate, that portfolio only gives you about $18,000 per year. If your essential spending gap is $36,000, that's a problem. You just failed the test. That's exactly how people end up house wealthy, freedom poor. They look safe before closing, but after a downturn, they can't cover essentials without selling the home or slashing their lifestyle. How do the wealthy fix this? A few ways. Buy a smaller place, take a mortgage to keep more cash invested, delay the purchase until liquidity builds, or set up a HELOC before they need it. The bottom line, don't sacrifice cash flow for the false badge of a paid-off home. Test 2. All-in cost comparison. Most buyers compare mortgage payments to rent. It's a terrible comparison. The right way is to compare the total cost of owning against the total cost of renting the same lifestyle. I learned this from a Chinese entrepreneur who once told me, Americans think with their hearts about houses, but with their heads about stocks. Wealthy people use logic for both. For ownership, you've got mortgage payments, property taxes, insurance, HOA dues, repairs, and long-term maintenance. Budget at least 1 to 4% of the home's value yearly for that. If you'll move in 7 to 10 years, also include the buy-sell costs, which are usually 9% of the home's value spread out. And here's the hidden cost, opportunity cost. A $300,000 down payment could earn you $12,000 a year at 4% if invested instead. That's real money lost when it's tied into the house. Here's a breakdown. A $700,000 home, 20% down, 6.5% mortgage. Mortgage is $42,000 yearly. Property taxes, $8,000. Insurance, $3,000. HOA, $2,400. Maintenance, $10,000. Transaction costs are $9,000 annually if you move in 7 years. That's $76,000 out of pocket. Add $5,600 in opportunity cost, and ownership is $81,000 per year. Renting the same lifestyle? $4,500 monthly plus $300 insurance is $54,300 annually. That's a $27,000 difference in favor of renting. Even cash buyers don't escape this math. No mortgage drops your cost to $32,000 yearly, but your opportunity cost balloons to $28,000 on the full $700,000. Total, $60,000. Still above renting. Rule of thumb: if owning doesn't beat renting by at least 10%, lean toward renting. And if it's a close call, flexibility usually tips the scale in favor of renting. Test 3. Concentration risk. Here's where most people, even successful ones, blow it. This test asks, after buying, will your primary home eat up too much of your net worth? If yes, you lose diversity, tax strategies, and flexibility. Wealthy families cap home equity at 30 to 40% of net worth after purchase. Anything higher means you're not safe. You're overexposed. Take one consultant in Texas I worked with. He had $1.2 million net worth and wanted to pay $750,000 cash for a home. That would make his home 62.5% of his wealth. Translation: a huge gamble on one neighborhood, one tax district, one insurance zone, one economy. If anything changed, he'd be stuck. The fix was counterintuitive. He took a mortgage instead. Putting 40% down left $900,000 liquid. His concentration dropped to 25%. That mortgage actually reduced his risk by keeping his portfolio diversified. People fail this test because they hate debt. They assume appreciation equals spendable income, or they forget that equity doesn't pay the bills without selling. Don't repeat that mistake. Test 4. The flexibility premium. After 50, adaptability becomes priceless. This test measures how much you're willing to pay for the option to pivot fast, whether it's helping kids in another state, moving for health, or chasing a business opportunity. Run the numbers. Same $700,000 home versus $4,500 rent. If there's a 50% chance you'll move in 5 years, and that move could save or earn you $60,000, here's the breakdown. Owner moving costs are $63,000 in transaction fees, plus 2 months double housing, plus moving, which is around $77,000. Renter moving costs are lease break plus moving, which is around $12,000. That's a $65,000 flexibility penalty for owning. The expected value of moving fast, $30,000, doesn't outweigh the cost, $65,000. Renting clearly wins. Quick diagnostic. Ask yourself, would I pay $15,000 for the ability to relocate anywhere within 60 days? If yes, flexibility should weigh heavily in your choice. Test 5. Aging ready and insurable. Finally, a property after 50 must be both accessible and insurable. Otherwise, it becomes a burden instead of a blessing. Run an aging ready checklist. Step-free entry, bedroom and full bath on entry level, walk-in shower, wide doorways and halls, laundry on main floor, non-slip floors, strong lighting, reinforced shower walls, covered parking. Score 8 or 10 is ready. 6 to 7 is budget for upgrades. Below 5, keep renting until you find better. Insurance is the other trap. Calculate your insurance to value ratio. Premiums divided by home price. Under 0.6% is safe. 0.6 to 1% is caution. Over 1% is danger. I've seen people retire into disaster because insurance costs spiked. Florida buyers especially, hurricane premiums alone can wipe out budgets. Wealthy buyers always get quotes before falling in love with a property, and they plan for premium hikes. Final decision framework. Only buy if all 5 conditions hold. You pass the liquidity test comfortably. Owning costs at least 10% less than renting. Home equity stays under 40% of net worth. Flexibility isn't sacrificed or you're certain to stay long-term. The house is aging ready and insurable. If the math is close, let liquidity and flexibility make the call. If you fail liquidity, concentration, or aging and insurance, renting is the safer move. If you do buy, keep equity under 40%, take an affordable 30-year fixed mortgage, save 1 to 2% of the home's value yearly for maintenance, get a HELOC before you need it, and sync your estate planning. If you rent, invest the difference automatically, negotiate flexible leases, pick aging-ready units, and use the freedom to test new areas before committing. The wealthy don't worship houses. They run these 5 tests. Run them yourself before you fall for granite countertops. Your future self will thank you. And if you want the one-page checklist and calculator to run your own numbers, you'll find it in the description. If enough people want it, I'll also make a part 2 on advanced strategies like house hacking, geographic arbitrage, and estate planning with property. Remember, after 50, security isn't about the deed. It's about liquidity, flexibility, and a plan that safeguards your freedom, not your pride. So tell me, on a scale of 1 to 10, how useful was this framework for your housing plans? Drop your score in the comments. I read every single one.